Good day and welcome to the latest series of NCREIF Analytics on Demand. As of this recording, we find ourselves in a unique time frame in history. I hope you are all safe and healthy at home, and that as you will see in this module, your real estate portfolios have low levels of leverage. Before we review the NCREIF leverage data set, we have a quick review of what financial theory says about the topic. Leverage is not always accretive to returns. When unlevered total returns fall below the cost of debt, including fees, levered total returns will fall. In this example, the unlevered return for asset 1 is 8%, 300 basis points above the cost of debt, and yielding positive leverage of 11% at a 50% LTV ratio. However, in the case of asset 2, total returns were below the cost of debt and leverage returns fell, specifically becoming negative as LTV levels rose above 40%. The other side to the theory is that risk always increases exponentially with the LTV ratio. In this example, asset 1's unlevered risk doubles from 7 to 14% at a 50% LTV. The MPI is reported on an unlevered basis for benchmarking purposes to allow for an apples-to-apples comparison. However, many people don't realize that the property-level debt is also collected. In addition to the usual data points of NOI, capital improvements, market values, and partial sales, as part of the NCREIF levered total return equation, we also collect the loan balance, both at cost and market, the interest expense, which include loan fees, all regularly scheduled loan payments, all new loans, and any loan proceeds. Using these new data points, Analytics has added several new leverage KPIs: levered income and total returns, loan-to-value ratio, effective interest rate, and the percentage of properties that hold leverage. We can see these KPIs in action using the Market Operations Report in the KPI collection leverage. All of these KPIs are available for all geographies and property sectors. The first chart in the report shows the loan-to-value ratio by property type. This represents the entire NPI, including properties with and without debt. Over this 30-year history, leverage has generally increased from around 20% in the 90s to 40% at the height of the financial crisis. LTVs have since stabilized to about 30%, with noticeably lower debt levels on industrial properties. Analytics also reports the LTV ratios for the universe of only those properties which hold debt during a particular quarter it is in the NPI. This is a slightly different story. These levered properties, market cycles aside, generally have about 50% leverage. This next chart explains the general rise in leverage and shows the percentage of properties in the NPI that hold leverage. Right away, we can see that the popularity of leverage increased from around 40% of properties having leverage in the 90s to near 70% today. Notice how apartment properties became more in favor as industrial assets became less levered, with only a third of industrial properties holding leverage. Note the interest rate spreads between these two sectors in the next chart. The effective interest rate is computed from the interest expense, including all fees, at the contract interest rate. This entire 30-year period has seen effective interest rates fall from 10% to 4%. Time will tell where we go from here, but as of today, the federal funds rate is near zero, much of the EU has negative interest rates, and Japan has had rates below 1% since the 1990s. So how has this leverage affected the returns of the NPI, you may ask? Scrolling down through the report, we can see the levered income and total returns, then the levered only property returns, and lastly the unlevered returns. These returns are all computed with the reported debt by the membership at the contract interest rate. NCREIF collects the debt mark to market, and we expect to add it to analytics in the future. While the shapes of the returns are generally similar, note the differences in the y-axis scale. The unlevered range goes from negative 25 to positive 25, the levered range from negative 40 to positive 40, and the levered only range from negative 60 to positive 60. It is important to realize that while leverage can increase the total return, it always increases the volatility of the returns. These differences are better viewed in the summary table. Let's focus on the differences between the unlevered and the levered-only statistics. Note the 30-year NPI unlevered total return is 8.1% with a standard deviation of 8%, whereas the 30-year levered-only total return is 10.2% with a standard deviation of 15.6%. That's a 201 basis point increase in returns with the volatility nearly doubling. Not bad over the long term, but look at what's happening with retail this past 1 and 3 year periods. Leverage reduced returns by 30 and 50 basis points respectively. And the mark-to-market of the latest crisis hasn't even been recorded in the data yet. A few words of caution. The NCREIF NPI is a portfolio of properties, and the debt cost and leverage levels are not constant over time. When benchmarking individual portfolios where the debt level may differ from the NPI, delevering the returns, or modeling fixed-rate loan benchmarks may be appropriate. Another way to view the leverage data is with the Interactive Operations Report. This report is a sortable table comparing the property sectors and geographies. In this example, we are showing the percentage of properties that hold leverage for all of the NPI subproperty types. Note that almost 90% of superregional malls hold leverage. For those who want to dig deeper into the math, theory, and strategic implications of using leverage, please see Joe Pagliari's paper, Some Thoughts on Leverage, Fees, and Net Returns. This wraps up this NCREIF On-Demand Education module. We hope this information will help you in deciding the appropriate debt strategies based on your risk tolerance. If you have any questions or suggestions, please ask the question to the knowledge base or call the staff at NCREIF. Thank you.